Hey, what's going on, everybody? It is Ryan Hernandez, founder of Enhanced Wealth, and I wanted to make this video talking about the Enhanced Wealth Financial Freedom Framework. You've probably seen some of my short form content videos briefly talking about it, and you came to my YouTube channel because you want to get a better in-depth understanding of exactly what it is, how it works, and how it can help you. So, in essence, the Financial Freedom Framework is exactly that. It's a framework, it's a system that helps you become financially free. And if you're already uber wealthy, it'll just help you create more wealth passively, and it'll just help you grow and scale your already successful portfolio. And in a nutshell, this is how it works. You have money, and you're either making money through trading your time for money with active income, or maybe you are an individual who already is very wealthy. As I mentioned, maybe you have a high-paying job, you make $250,000 plus a year, you already are invested in real estate or crypto or stocks or heavily invested in gold or whatever it may be, right? The first step of the Financial Freedom Framework is to actually contribute into a cash value life insurance policy, but specifically the IUL. Now, I'm going to get into in further detail as to why we use the IUL opposed to just say high yield savings account or a CD or any other type of account. Well, one neat thing about the IUL is that you can borrow against the policy, right? So all the money that you're placing inside of the policy is working hard for you. Your money is making money for you. Again, I'll get into deeper context as to why we use the IUL. But just know that you're able to borrow against the policy, and now you can leverage and pull out the life insurance company's money. Your principal, the premiums that you paid into the policy, stay in the policy and continue to keep making money for you. You're going to leverage something that's called OPM, other people's money. In this specific case, with the way that we've structured the system, you're going to take the life insurance carrier's money and you're going to go invest it into commercial, multifamily, syndication real estate. You can plug and play any income producing asset with this system, which is very cool. It's very versatile. Any income producing asset that you want. It could be car washes. It could be investing into your own business, continuing to expand your business. It could be single family real estate. It could be gold, crypto. Anything that you want to do that is a cash flowing, positive, income producing real estate or any other income producing asset. It does not matter. We specifically talk a lot about apartment buildings because we are professional real estate investors and we are syndicators. We go out and we find these apartment buildings. We actually get these apartment buildings under contract. We go to the banks and we get approved for the funding to buy these deals. And what we do is we partner with people because the everyday working John or Jane or even the super uber wealthy John or Jane don't have the time to go out and learn the ins and outs of real estate. They would much rather just be a private, passive investor, a silent partner in our deals, and they would rather just place their capital in our deals, partner with us, have us operate and manage these properties, and they just receive cash flow. So the cash flow that comes out of these properties, keep in mind, guys, we're collecting rents on these properties. And we really don't ever go after apartment buildings that are less than 100 units. So we are purchasing and acquiring commercial multifamily real estate or apartment buildings and very large apartment complexes. Then what happens is that this cash flow can do many different things. This cash flow can pay for your lifestyle. This cash flow can pay all of your bills. This cash flow can go back into the IUL. Not all of it. Maybe some of it goes towards bills, some of it goes towards your lifestyle, and some of the funds that you're making passively through income producing assets can go into the IUL to do one of two things. This money can either go into continuing to grow the amount of money inside of this cash value life insurance policy, or what you can do if you wanted to pay back those loans and replenish the quote unquote line of credit, then you can do that too. So now that you know how it works, let's dive deeper into the actual system itself. and how the IUL plays such a key role in this entire system. So when you place your capital into the IUL, your money is really getting divvied up into two buckets. Now, all of your principal that you pay into the policy plus all of the interest you earn on your principal goes into bucket one. Now, the official name for this is your accumulated value. All of the money inside of bucket one is earning a high yield of interest, historically about 10% interest, and you're earning this interest tax-free. You'll never pay capital gains tax on it, and there is zero market risk. Your money is not susceptible to market volatility. And the reason for that is because your money is not invested in an investment. This is life insurance. Life insurance is not an investment. And so because you fall underneath the umbrella of life insurance, you're taxed completely different. And on top of that, there is no market volatility because your money is not actually being invested into the stock market. You are strategically placing capital inside of a high-yielding cash value life insurance policy. Now, bucket number two. Bucket number two is essentially as if the life insurance company just gave you a secured credit card, and the secured credit card, the balance on the secured credit card, just like when you get a secured credit card, the balance on this credit card is, or your spending power on this credit card is the amount of money you put on the credit card. Very similar here, guys. The second bucket, this for just simplicity, think of it as the life insurance carrier is giving you a secured credit card. So if you put $100,000 into the IUL, you're getting a line of credit for $100,000. If you put $50,000 into the IUL, your line of credit is $50,000. So for example, if you are saving, let's just say $6,000 a month into your IUL, that's $72,000 you've placed into the IUL. You're going to earn interest on that $72,000, and now your line of credit, that secured credit card, for simplicity purposes, has a spending power of $72,000 plus some change because obviously you're earning interest on that. So you are getting something with bucket two or with the IUL that's called uninterrupted compound interest. Now, what does that mean and how does that really even work? Well, keep in mind, all the capital that you place into bucket number one is not getting touched. You're never really touching this money. The money is continuing to sit in here earning uninterrupted compound interest. And the reason why you're able to earn uninterrupted compound interest is because you never have to touch the money in bucket one because you can just spend the money in bucket two, right? You can spend the life insurance carrier's money while your money continues to sit in here earning a high yield of interest tax-free with zero market risk. You are leveraging the life insurance carrier to spend the same dollar twice. You also are taking loans out at 4% interest. That's what the interest is right now. Interest rates, there's tons of rumors that interest rates are going to lessen 4 different times in the year of 2024. And so the interest rates on these loans will decrease. Now, historically, interest rate loans inside of cash value life insurance policies, specifically the IUL, is always less than what the interest rates are when you go to a bank. All right, interest rates right now are about 7%. The interest rate on a loan from your policy is 4%. And keep in mind, we're looking for our money to make money for us. We are positively arbitraging on our money right now. Because if my money is earning 10% interest inside of my IUL, right, and then I go take out a loan at, let's just say, 4% interest, because that's what it is at the time of making this video, I'm positively arbitraging 6% on my money. So now all my money in bucket number one, assuming that loans have been taken out, is roughly doing about 6%, right? And now the money in bucket number two that I've taken out and now is inside of commercial multifamily real estate or invested inside of apartment buildings, well, the average rate of return on these apartment buildings is 18 to 20%. And that's when we underwrite these deals extremely conservatively, right? We're always looking to underpromise so that we can overdeliver. So when we underwrite these deals conservatively, the annual rate of return after we underwrite the deals normally comes out to anywhere from like 18 to 20 to 22%. So now I'm making 6% here, And now the money that I took out of bucket 2 that's now in the real estate is now doing anywhere from, let's just say, 18 to 22, right? And again, OPM. We're leveraging other people's money in this entire process, which is incredible. Now let's kind of talk about more as to the benefits of partnering with us on these deals and investing in apartment buildings. It's completely passive for you. We're the operators, we're the managers, we are the people going out and acquiring the properties. We're finding these deals. We have a bunch of acquisitions people constantly out looking for new investment opportunities for us to acquire, right? We have an entire team of more than 6 people, and we're all professional real estate syndicators. And what we're doing is we're going out to get these deals, and then you partner with us on these deals. And again, the reason why you'd want to partner with us in a specific syndication deal is because it's completely passive for you. These investments are also historically some of the most stable and safe investments that there are. Now, obviously, every single investment inherits risk, right? However, in terms of looking at all the different investments that are out there, every single investment, no matter what, every single investment on planet Earth accrues some type of risk, some more than others. Well, here's the thing with these apartment buildings. Again, we don't really touch anything under 100 units. We go for 100 units plus. And so with the state of the country in the United States, what's been happening a ton is that more and more people have been having to rent, because the gap between how much you make and how much it costs to purchase a home in the United States does nothing but continues to get larger. The gap is just continuing to get larger and larger and larger. That's why you hear all these people say that, you know, the middle class is slowly dwindling away, right? Because everything keeps getting higher in price and value, but people are not being compensated at the same rate as inflation, right? And another thing too is that, guys, we have hundreds of people living in these units, hundreds of people living in these apartment complexes. And we only strategically get these properties in emerging markets, right? Most of our deals are in the Dallas, Fort Worth, Austin, Houston area. Why? Because everybody's moving to Texas, right? We have quite a few of our apartment complexes that are within our portfolio in Arizona. Why? Because everyone's moving to Arizona. So we look at what are the emerging markets. We're pulling state data, we're pulling employment data, we're pulling population data, and we're doing all that homework, right? We're doing all of the heavy lifting. You simply just place your capital in our deals. We partner together. You're a passive investor, and we're doing everything else. Also, we get a lot of forced appreciation out of these deals. The thing with single family or residential, anything 5 units or less is considered residential. Now, the thing with residential properties is that the value of your property is based off of the comp system. What are the other comparable properties with the same square footage, same bedroom, same bath? What are they selling at? And that's going to determine the value of your home, right? So we don't really have much say in that. That's not really under our control. But the value of these assets and what they appraise for, we totally dictate, right? So we're always looking for opportunistic deals to invest in. If we see that an owner is not charging market rent, let's just say they're charging $950, but market rent is actually $1,200. That is a very opportunistic asset for us to get into. Why? Guys, we're walking into equity on this deal. We get the deal. It's ours now. We raise all the rents to market rent. And now the actual property itself is cash flowing way more than it was, because you take 250 people and then you take the difference between 950 and 1,200, you multiply that by 250 people, then you multiply that by 12 because there's 12 months in the year, and that's the increase of cash flow that this property is doing every single year. Now, because we just increased the amount of money that this asset is making every year, when we go to sell this, we've forced so much appreciation out of this property. Not only that, but there's so many other strategic value adds that we can do. We can go ahead and actually rehab the property. We can rehab the landscaping. We can start charging for reserved parking. We can start charging pet rent. We can start charging for valet trash. We can pump out money out of these properties in so many different ways, and we can reduce the expenses, right? We can go get a ton of bids from, the garbage people who come and pick up the garbage. We can get a bunch of bids and go for the cheapest one. We can go get a bunch of bids from different landscapers and we can get the cheapest one. So we can go get a bunch of bids from different property management companies and we can get the lowest bid. So we can lower the expenses and increase the revenue, which is going to tremendously increase the value or the appraisal value of this property, which is great for us and our investors who partner with us. And there's 4 different ways to make money with these deals, plus one added bonus. So the first one I just talked about, appreciation. You make money through appreciation. You invest $100,000 into this deal. Let's just say that $100,000 turns into $230,000. Boom. You just earn money simply due to appreciation. Not to mention, all of our partners get paid cash flow quarterly throughout the holding period. If we hold this deal for 3 years, 5 years, whatever it may be before we sell it, you're earning cash flow throughout the entire holding period. So you're making money. That's the second way. The third way is through reducing your tax liability. What is the fastest and easiest way for you to make more money? Reduce your tax liability. Keep more of what you make. You already made it. If you figure out how to keep more of it, then you're increasing what you actually have in your pocket at the end of the day, right? You're giving Uncle Sam less of a cut, which means you're keeping more profits. Commercial multifamily real estate, apartment buildings is a strategically, just a great way to do that. We have so many high income earners that they literally just invest with us. They don't care about the cash flow. They don't care about the appreciation. They're just trying to wipe out their tax liability. So the way that they wipe out their tax liability is that they use the depreciation of this real estate to wipe out either some of their tax liability or all of their tax liability. Depends on how much money that they actually invest into the deal. Now, if this is you, if you are somebody who makes a ton of money and you have a big check that you have to write to Uncle Sam, well, we can look at that check and say, okay, you owe Uncle Sam X amount of dollars. You would have to invest X amount of dollars into this deal to wipe out your taxes. And a lot of big players, high income earners, they do that. So that's the third way that you make money through this deal. The fourth way is the simple fact that we go into debt, right? This is more so on us. We get approved for these loans. We are paying for the majority of the price of this property through loans, and we're not even paying the loans back. Robert Kiyosaki is very famous for saying that true wealth is created through debt. How? How is that possible, right? I thought debt was bad. No, credit card debt is bad. Going into debt to buy a car is bad. But going into debt to buy an asset is incredibly smart, right? Because you can buy a $10 million apartment complex, and then what happens is you only actually got $7 million of that from a loan. So the bank gives you $7 million and you go buy a $10 million apartment building, and the 100 tenants that are living in there pay the debt down. They are paying the mortgage. We're not paying the mortgage. So we're acquiring all these assets. We're acquiring millions of dollars of real estate, and we're not even the ones paying the loans back because our tenants are paying down our mortgages. That's how true wealth is created. It's an absolute cheat code. And the bonus one. Well, the bonus one is quite simple, guys. Don't forget about the IUL. The IUL, you're still positively arbitraging that 6% on the side. So those are the 5 different ways that you can make money leveraging the Enhanced Wealth Financial Freedom Framework. If you want to learn more about either leveraging an IUL, if you want to learn more about just the Financial Freedom Framework as a whole, how the whole thing works together, and you want to possibly get started or ask us questions, or if you want to learn more about how you can potentially invest with us on future deals, go ahead and use the link that is in the description of this video down below, and go ahead and check out our website. You can book a call with us. You can join our community. There's going to be a few different options for you based on what you would like to do. Appreciate you guys watching this video. Share it with family, share it with friends, share it with some of your investor buddies, and I wish you the best.